Hello, everybody, and welcome to a special edition of the Sharesify podcast. Today, we're delighted to be joined by Rebecca Maclean, who manages Dunedin Income Growth Investment Trust alongside Ben Ritchie. Hi, Rebecca. Thanks for joining the podcast.
Hi, thanks for having us.
Excellent. Now, Dunedin's one of the oldest investment trusts, isn't it? Dating back to 1873. And for more than 45 years, the trust paid a steady or a rising dividend. Today, you offer a competitive yield and you've got strong revenue reserves. Rebecca, can you tell us a bit about the trust's investment style and objectives?
Yeah, as you say, it's one of the oldest investment trusts. It's the second oldest in the UK, and it's been around for a long time. But I think that really speaks to the benefits of the sector being able to navigate change. So the investment objective remains very similar to it was 150 plus years ago, which is to deliver growth in capital and income for shareholders. But the way that's been delivered has changed. When the trust was first founded, it was investing in railroad bonds in the United States, which was at that time an emerging market. Yeah. So we're now mostly investing in UK equities. We're in the UK equity income sector, but we are looking to invest in quality companies and companies that we think can deliver resilient income to investors. So it's a total return approach to investing. So it's looking for companies that are not just high yield, but actually can deliver capital growth as well. So these are quality businesses. And it's quite an active portfolio. So we've got about 36 companies in the portfolio, so high active share. And we're really trying to pick the best ideas for the trust.
Sorry, Rebecca, that concentration is quite an interesting point because it is concentrated. 36 is what most kind of ballpark of what most concentrated portfolios would be around that kind of size. You mentioned about being very much exposed to London listed shares, and yet your largest holding is, of course, a French company, TotalEnergies. 9%, I think, of the portfolio, give or take, at the moment. Why don't you just give us a bit of a steer as to what drew you to TotalEnergies?
Yeah, so the trust can invest up to 25% overseas. We currently have got 16% invested overseas because plainly we're seeing lots of opportunities in the UK. But our biggest holding, TotalEnergies, it is it's our preferred integrated oil and gas name globally. Actually, our sector analyst has got Total as his top pick. And if you think about the benchmark exposure to energy, the FTSE All Share, it's been a benefit this year. It's got about 10% exposure to energy. So we're looking at that as in a risk profile as well in terms of the benchmark. So we have Total. We also have a company called GTT, which makes membranes for LNG carriers. And between the two of those holdings, we're just a small overweight the energy sector, but a quite different positioning. And the reason why we like Total is that it is a better fit for our investment process. The company has had a very consistent strategy, whereas some of its peers have been changing in terms of their priorities. This has got a strong balance sheet. It's very cash generative, and this has allowed it to continue to grow its dividend. So unlike BP and Shell, which cut their dividend during COVID, Total didn't. So it does have that track record of resilient income paying, which fits with this mandate in terms of delivering for shareholders. So it's got the sort of the financial characteristics that we prefer to peers. And then from a sustainability perspective, the trust has got a sustainability approach, but that includes transition companies. And Total had a very consistent transition strategy around investing in renewables and power, LNG. And so that means it's a good fit from that perspective too.
Great.
Excellent. And just circling back to that point on quality as well, Rebecca. So, what things do you look for when determining the quality of potential holdings?
We rate all the companies in our coverage on quality, and there are sort of 5 aspects of the quality for us. So we look at the quality of the industry, the industry structure, the extent to which there's growth, there's pricing power within the industry. We look at business model and moat. So what has the company got a competitive advantage, and is it a sustainable competitive advantage, which will allow it to then generate higher returns for longer? We look at the quality of management, what's their track record in terms of capital allocation, strategy, execution. The financials is clearly important. So looking at the balance sheet strength, the cash generation of the business, the returns, and we're looking for companies which are able to, at least cover their cost of capital in terms of the returns that they're generating. And we don't want to be taking excessive leverage in the portfolio. And then finally, around ESG as well. So we're looking at how the company is managing the key environmental, social, governance facing it, or indeed are there any opportunities. So we rate the companies on that basis, and we are looking to have a portfolio which is higher quality than the index, and we do. So if you look at things like the return on equity of the portfolio, it's an over a 20% premium to the benchmark. It's got about 25% lower leverage than the benchmark and higher operating margins. So you're seeing that stock selection translate into overall portfolio which is higher quality than the benchmark. And I think we'll come on to talk about valuation, but you're no longer paying a premium for that quality in the UK market, so you're getting those superior characteristics which we think will which will demonstrate themselves in terms of resiliency through the cycle, but you're not having to pay a premium anymore over the market for that, because there's been such a strong re-rating of the market, particularly in cyclical sectors.
Yeah, interesting. I mean, talking about the high qualityness of the portfolio, I'm just spinning through. I mean, we mentioned Total. I see Relx is well up there in your list, and also the LSE. The LSE has been caught, and then it seems to have got a split opinion. Some fund managers and investors would really like them to spin off the markets part of the business from the data side of the business. But you seem to have a different viewpoint. What is your view on LSE?
Yeah, I think the company, the main debate around London Stock Exchange Group in the last year has been the risk around AI to the business. And, I think the company probably started off with maybe sort of, with where there being elevated concerns around AI risk for the company, but it's really demonstrated that that's not the case. And I think its presentation, its communication, and its results are providing support for the thesis that actually LSE Group could be a winner within an AI world, in that it drives greater use of data, and their proprietary data sets, the extent of their data, the extent to which it's open to be used by these AI models, means that it's actually driving that data demand. And so ultimately this means that rather than it being a question of what's the terminal value of a business like LSE, you actually start to think, could there be a growth acceleration on the back of that? So yeah, I mean it's a similar argument on Relx as well. That's a company which provides data and analytics services across like legal, but also risk. They do events as well, data at science and academia. And the concern there over the last year has been, to what extent these models will be able to cut out what Relx does. But I think what the company is starting to show, but I don't think we're fully there yet in terms of the market's understanding, is that ultimately it's the value of the data and the trust that you have in that data, which is what's needed and will be placed at a higher premium. And they are investing in AI tools which allow their customers to get more value from their data. And I think that's probably something that the market needs to see more for. But yeah, that sort of AI debate certainly something, it sent a lot of volatility in that part of the market. And I think we are starting to see a recovery in those shares, as maybe there's a bit of a sort of distraction about other things going on in the market as well. But hopefully, just as those companies deliver resilient results, then that concern around the terminal value can be something that can be eased.
Sure. I mean, I think there are some parallels to be drawn with the frothy days of the dot-com era, and I think people who look through the noise said, well, content will be king, and here it's data is king. If you own your own data sources, your own content sources, that is going to be a real crown jewel in your.
Absolutely.
Just looking also at the discount, Rebecca. So it's just below 9%. How does that kind of pitch relative to history, and what's the what are you and the board doing to manage that discount?
Yeah, it's definitely front of mind. It's something that's an active conversation at the board. It has come out. I mean, the sector has come out this year. There's a correlation between interest rate expectations and discounts on the trust, and so it come in a couple of points, but it's now come back out with with the most recent volatility or concern around inflation. So, I think the board's been very active. So there's been an ongoing buyback. The trust bought back nearly 11% of the shares last financial year in order to support the discount. And then also from a strategic perspective, the company announced an enhanced dividend policy last year. So this relates to the distribution strategy. So there's a one-off step change in the dividend payout, which represents about 6.2% of the shares. So you're getting quite an attractive dividend yield, 6.2%, when you compare that to the markets on 3 and 3.3%. Also, even within the UK equity income sector, that is the highest dividend yield. And that's a way of being able to encourage investors to look at their shares. So we think that the proposition is you're getting a differentiated portfolio of companies, higher quality, as I say, than the index. These are really resilient businesses that provides downside protection for performance. It means that you don't sort of enjoy the upswings in the same way as a cyclical bounce in the market, but it does provide downside protection, as we saw in COVID in terms of relative performance and also the dividend payments. But that's not at the expense of the dividends that you're getting. So as an investor, you're getting over a 6% dividend yield. So we think that going forward, you'd probably be getting about 60% of your return in dividends, and then the rest we see as being underlying total return potential of the portfolio. We think that you can be getting double-digit return given the companies that are in the portfolio.
Rebecca, that will certainly make some investors feel more comfortable in your confidence, because performance-wise, it hasn't been the strongest period in recent years, 3-5 years or so. Total return has generally lagged the wider UK equity income sector, although you've got a long record of beating inflation, which is also really crucial to income seekers. I just wonder how you explain that dynamic to your shareholders.
Yeah, I mean, the UK market has performed very strongly over the last few years. I mean, over the last 2 years, it's delivered about 15% annual return. Over the last 5 years, it's about 11%. So this is certainly a step up over the sort of much longer term track record for the UK market. And it has been concentrated in those cyclical sectors. So the best performing sectors in the UK market have been energy, mining, banks, particularly banks, and also aerospace and defence. And so from a quality perspective, these are typically sectors which have got more volatility in their dividend payments, because their dividend payments are dependent on external factors like the oil price or interest rates. And we saw what happened to the bank sector during COVID in terms of their dividend cuts. And so as a quality investor and looking for those companies where we've got confidence they can pay that dividend through the cycle, it means naturally we're sort of more likely to be underweight some of those cyclical businesses. So the portfolio as a whole does not typically outperform in a rising market, particularly when it's driven by cyclical sectors, but it does show downside protection. So when things get tough and the market falls, then the portfolio has outperformed historically in those environments. So I think really the value of quality, quality as a factor has underperformed over 5 years because you don't really see the value of quality until things start going wrong. Yeah, and that's when you see that sort of the drawdown protection that you're getting, and the value of resilience is something that we think, given the outlook and the uncertainty that there is in terms of growth and inflation, macroeconomic factors, geopolitical factors, we think that the value of resilience will start to come to the fore. And as I say, it has been a period of tough relative performance. But that valuation premium now that you're paying for the portfolio, which is a high quality portfolio, has come into levels that we've not seen for many, many years. And so you're not paying up for quality. So actually that could suggest that it's an opportunity in terms of looking at the shares at this point.
That's really fascinating, Rebecca. I think that's probably about time to wrap things up. Thank you very much for your time, really illuminating stuff there. And listeners, thank you very much for tuning in. We do these podcasts on a regular basis. Keep your eyes peeled, and we will see you no doubt sometime later in the week. All the best until then. Bye-bye.